So this lecture is going to be about Chapter 9, Decision Making and Relevant Information. Um, the first part of the chapter goes back to the 5-step decision-making process that we've talked about throughout the book. Like I've said in previous classes and just in general, in my opinion, the 5-step process is kind of a little formulaic as far as what actually goes on in the real world. So, I definitely not an advocate of trying to memorize that or trying to apply it in practice as some type of rote action that you have to, you know, step 1, step 2, step 3, step 4. But I don't think it hurts to have in your mind a formal method of making different analyses, and that's one of the things that we'll talk about today. So when we talk about decision models, a decision model is basically just that, a formal way of making a choice, often involving quantitative and qualitative analyses. And like I said, I don't think it's bad to have a formal model, um, but whether or not, and a formal model would be, the 5-step model would be a formal decision model where you have the 5 steps and you're going, okay, step 1, step 2, step 3, step 4, step 5. Even if you have one, like if your company has a formal model that is, company policy to go through this model, um, I think what ends up happening is that's kind of the framework for decision making. So you have those things kind of in the back of your head, but then as you actually get into the nuts and bolts of making decisions and running an organization or managing an organization, um, even though that framework still kind of exists in your mind, you're not actually reading down the list and being that formal about the way that you think. Um, so, it is what it is. But however, whatever type of model you use to um, kind of try to break down the analyses that you do as a manager, one of the more important things that you want to do is be able to filter relevant information from irrelevant information. And so that's one of the big things that we'll talk about today, because in the field of accounting or in managerial accounting, um, there are any number of different ratios, different accounting numbers that you could look at. And if you are not well versed in determining what's relevant and what's not relevant, something that could seem like it would logically be important to your decision making might not be the best tool to use to formally make the decisions that you want to make. So when we talk about relevant costs and relevant revenues, um, we're basically talking about items that are going to occur in the future, and we're talking about this in the context of looking at alternatives, making a decision where you have more than one different choice. Because obviously, if you only have one choice, you don't really need to analyze anything. You're just going to make that choice, and you're going to try to deal with it the best that you can. Now, when you have multiple choices, obviously, as a manager, it's your job to try to pick the best choice to reach whatever goal it is that you have as a manager. So, when we talk about relevant costs and relevant revenues, we're talking about that in the context of relevant to the decision-making process of choosing between alternative A and maybe alternative B. So for these to be relevant, they have to occur in the future, and they also have to be different among the various alternative courses of action that you're looking at. So obviously, if you're looking at 3 different courses of action, and all of the revenues and costs associated with those courses of action are the same, except for maybe 2 costs or 2 areas of cost and a small amount of revenue. Well, the ways that they differ, and I know this seems kind of obvious, but obviously you don't want to spend any time analyzing similarities, because Where they're similar, that doesn't help you make the decision. That doesn't help you make the decision. Um, the decision is made in choosing the best course of action based on what the differences are and how that ends up working out for your whatever organization you're working for. So as a component of determining relevant costs and revenues, there's this concept called sunk costs. And those are basically any costs that have already occurred. So kind of by nature, these would be costs that are incurred in the past that you've already paid for. And obviously the reason that you should not be I think some people have the tendency to look at two options and say, well, I've already invested, you know, X number of dollars in this project and I don't want to lose all that money. So even though project B works out better every year from now until forever, since I've already invested all this other money in it, I'm going to say, well, you know, it doesn't make up for that lost money that I would have had if I give up project A. Well, that's kind of one of the big decision-making traps that we don't want to fall into, because we're analyzing decisions that affect basically from now until however distant in the future that we're looking. And anything that's happened in the past is not relevant to what happens in the future. So just because I already invested $50,000 in one of these two options, I'm not worried about that. What I'm more worried about is if I have to invest more money in option B right now to make that a viable option, then obviously that factors into my analysis. But if I don't have to invest anything further at this moment or into the future for either option, then all I want to do is see, you know, I may have some remorse for having wasted money in the past, but I want to say from now onward, what's the best course of action? And if I've already spent the money and I've already, you know, invested in one of these two options, but that investment doesn't, you know, change what's going to happen tomorrow or the next day in either of those two options. So you want to avoid the pitfall of looking at sunk costs. So what are some examples of sunk costs? So for instance, if you're looking, okay, do I continue on selling or manufacturing product A, or do I look at this product B, which is kind of the new, uses some new technology? Which one's going to be better from today or from tomorrow until the foreseeable future? Well, a sunk cost would be saying, hey, okay, well, I've already invested, you know, $200,000 in this manufacturing process for product A. Well, because of the nature of the technology in product B, it doesn't require that much upfront investment. So I really, to switch to B, I only have to invest another $20,000. Well, the analysis doesn't include the 500 or the 200,000 that I already invested in product A. The only thing that I should be analyzing is the difference between not having to invest any more money if I want to continue making product A, or having to invest an additional 20,000 to make product B. I'm only looking at my future costs. So the amount that I invested already to have the technology or the ability to produce product A would be an example of some sunk costs. So here's just an example of, in these first two columns, under all revenues and costs, we see that there's a $70,000 difference between alternative 1, which is do not reorganize. This is an example from the book. Do not reorganize the labor department or the labor force for one particular department. Alternative 2 is reorganize the labor force. So if you look down, there's revenues in the top line, look at all the costs, and you look at the operating income. Well, obviously, we're only going to analyze the revenues and costs that are different. So the revenue stays the same. We look down manufacturing labor cost changes. We look down reorganization costs change. So we see, okay, the both of these show a $70,000 difference, but the reason for that $70,000 difference shows up in manufacturing labor savings that we get from alternative 2 minus the reorganization costs that we would have to pay in order to do that. So I mean, it's pretty self-explanatory. If the revenues, if the numbers are the same, there's no analysis to be done. If they're different, we see why they're different, how they're different, and that helps us make the decisions. Okay, quantitative, this is kind of just some vocabulary here, but quantitative factors when we're making an analysis are outcomes that can be measured by numbers. So often when we think of quantitative factors, a lot of people initially just jump to the idea that, okay, these are financial factors. Well, there are quantitative factors that are financial, and so those would be basically anything that you're expressing as a dollar value. Okay, that's your quantitative factor. So in the previous example, direct labor costs. Okay, quantitative factor. Other quantitative factors could be non-financial, but they're still measured numerically. So this could be, alternative 1. Let's say we're talking about some other factor like labor hour efficiency. Okay, so every direct labor hour with alternative 1 is able to produce 3 units. Every labor hour under alternative 2 is able to produce 5 units of output. Okay, those are non-financial. We're not talking about money there. We're talking about units of output. But we are talking about something that can be measured numerically. And then qualitative factors would be anything that's going to be difficult to measure accurately in numerical terms. Now that doesn't mean that you couldn't. Let me give you an example of that. So, under alternative A, you could end up producing, ultra high quality goods that almost never break. Under alternative B, you're producing sub-quality goods or substandard quality goods that break very easily. Okay, so the qualitative, if we're talking about something in terms of the quality of the product, that doesn't lend itself to very easily being explained in numerical terms. That doesn't mean that you couldn't go in and say, well, I'm going to set this, let's look at quality of products on a scale of 0 to 100. That's where you're trying to quantify a qualitative factor. So this is something that wouldn't naturally lend itself to being expressed as a number, basically. So here's just kind of a summary, some bullet points of some of the key ideas, key concepts behind relevant information. Basically, this first bullet point is pretty important to remember that just because past costs are not relevant, not directly relevant in decision making, that doesn't mean that that it's useless information, because we are able to develop some guesstimates, some predictions of future events based on past occurrences. But what's key to remember here is the actual numerical values that occurred in the past, money spent, money earned, anything like that. It's only, as far as a decision-making process goes, it's only useful in as much as it allows us to more accurately predict the relevant future revenue or future costs for that product or alternative. In and of itself, the past information is not helpful to directly make the decision for what's going to be in the best interest of our organization for the future. And then you could basically sum up the next 2 bullet points by saying, when we're comparing future revenues and costs, we need to look at future revenues and costs that are different between the 2 alternatives, which we already talked about. And then the last bullet point there is just basically saying, hey, not everything is dollar values. there are other factors that need to be considered when making decisions. And so, this is where your managerial expertise comes into play, and you determine the appropriate weight to give to these other qualitative and non-financial quantitative factors. So oftentimes we'll come across a situation where we need to determine whether or not we should accept some one-time only special order. So this is a type of decision that it's not going to affect really our future numbers. It's kind of a one-time shot. It's going to affect one specific period of time. No long run implications, but still we're going to determine whether or not we want to take that special order, whether it's in our best interest, the best interest of the organization. We will compare relevant revenues and costs and determine overall profitability. This is pretty self-explanatory. Basically just that you can break costs up by business function, or you can look at costs, full costs, which consider all the variable and fixed costs throughout all of the combined business functions in the value chain. It's just an example of a situation where we're looking at a budgeted income statement. So these are guesstimates. These are pro forma budget, basically pro forma financial statement. And we're using absorption costing, so we're basically looking at the unit costs when including all variable and fixed manufacturing costs. So we see here unit costs of $12. Once we add in all of the marketing costs, our full cost of the product is $19. Revenue is $20 per unit, so our operating income is $1. So in this situation, we've got an opportunity to accept a special order. That last financial statement that we looked at is the assumptions for the entity without the special order. And so now we're looking, okay, what's the difference? If we take the special order, where are we at? If we don't take the order, where are we at? So column F here shows the relevant information from the special order, whereas column H basically gives you the difference between without and with the special order and all of the columns that contain relevant revenues or costs. You skip all the way down to the bottom there, and basically when you accept the special order, you are looking at a net gain in operating income of $17,500, and we would assume that would mean, hey, this is a good idea, let's accept this special order. If that number were to be 0 or negative, or close to that, around 0 or negative, we may look at it and say, well, if it's negative, we're going to for sure say no. We would be losing money overall, so this is not a good idea. If it's a very low number, again, you would have to look at the non-financial quantitative factors and the qualitative factors. Use your managerial discretion and determine whether that's a good idea or not. So a couple of potential problems when you're trying to run a relevant cost analysis that can be run into. Sometimes people make that first bullet point, make that general assumption that all variable costs will be relevant and all fixed costs will be irrelevant. Neither one of those is always true, as we can tell just by knowing that, well, first of all, we know that fixed costs are only fixed within a relevant range, as we've talked about before, and we also know that variable costs just means that they vary with units of output. It doesn't necessarily refer to varying as in being a different cost between two alternatives. So I think that's one of the problems with getting that mixed up in your mind. Also, if you're looking at unit costs can be misleading if that's the analysis that you're doing, because you don't know, unless you drill down and see what all is going into that unit cost. You have to determine whether, when you compare unit cost of alternative 1 and unit cost of alternative 2, are you including any non-relevant costs into that unit cost that are going to skew your analysis. Okay, so let's talk about some opportunity costs. So a make or buy decision is where you are determining whether you're going to try to do everything in-house or whether you're going to try to outsource any of your process. So here's just a look at an analysis of a relevant make or buy scenario. So we look at the total relevant costs there, so that's already broken down into only showing the revenue and costs that are relevant. And then over there, the last two columns on this little chart show the relevant cost per unit. And this is not a bad way to do it, of looking at unit costs once you've already established what the relevant costs are. That way you know that whatever's going into the relevant cost per unit is an actual relevant cost. So if we look down there, we can see that it's going to cost more per unit to buy than to make the DVD players, which is the subject of this example. So by breaking it down into relevant costs and then analyzing cost per unit, we can determine not only which one makes more sense from a cost standpoint, but also we can take that information, compare it to what we know quantitatively and qualitatively about the process, and determine whether it's a good decision. So again, this is a little bit of vocabulary. And incremental costs defined as the additional total cost incurred for an activity. Incremental revenue is the additional revenue gained from the sale of an additional unit or from the activity. A differential cost is the difference in total cost between two alternatives, and differential revenue is the difference in total revenue between two alternatives. Here's just a list of some of the strategic and qualitative factors that come into the analysis. These can be termed risks, and in order to minimize these risks, managers will sometimes attempt to make long-run contracts specifying costs, quality, and delivery schedules with their suppliers. However, that really only minimizes one side of the risk, and generally it's a safe bet. But if I know this doesn't happen very often, but if any of those aspects of costs, quality, delivery schedules, there may be a time in the future where you want, let's say that prices went down, or there's a new supplier that can get it to you cheaper or higher quality or whatever. You still have a risk, even with these long-term contracts. You're putting yourself at a different kind of risk, and that risk is that an alternative will come up that's better, but you can't take advantage of. This has been a big issue in the last 20 years that we hear a lot about this. Outsourcing, from a business standpoint, this can be, well, I won't say that it's ever good or bad per se. It gets a lot of negative press because, we as Americans don't like to see things that we consider to be good jobs going to other countries. But then again, we as Americans do like to pay lower prices for the products that we buy. So, whether or not that's a good thing, I will leave to your discretion. But just know that having that as an option adds another factor to the relevant cost analysis. One factor is to take advantage of or not to take advantage of outsourcing. If you decide to, then you have another risk that you could be looking at in the context of exchange rate, where money or currency exchange rate risk can, basically the value of your home country's currency versus wherever you're outsourcing to, and that can cause some issues. Again, this can be reduced with the use of forward contracts, but again, that really only protects you, assuming that that you know which direction the changes would occur in. So the total alternatives approach is a way of making a decision based on several alternatives, kind of to contrast with the opportunity cost approach. Under the total alternatives approach, and these are basically not all that different analyses. You'll see when we put the slide up of an example of this that it's really a matter of semantics. But under the total alternatives approach, future costs and revenues for all products are taken into consideration. Under the opportunity cost approach, you're basically looking at the contribution to operating income that you're losing by not investing whatever money or resource you are using for one project. By using it for the one project, you're not able to use it to, say, invest in treasury bonds or whatever the case may be. So you look at how you're using the resource, and then you look at what the next best alternative would be if you use that resource to try to make money in a different way, or try to reach your goals in a different way. And you look at what you could have gotten out of that resource had you gone with the next best approach, and whatever that amount is would be the opportunity cost of going with what you consider the best approach. So I know that can be confusing, but I'm guessing most of you understand what an opportunity cost is. It's basically the cost of not doing some other alternative. So I think this is where you can see how the issue between opportunity cost approach and total alternatives approach can end up being just a matter of semantics. So if you look under the first major row there, kind of the first half of that chart, panel A is the total alternatives approach to a make or buy decision. So your decision is either make this video system DVD player and do not make Digitech, or buy the video system DVD players and make Digitech this other product. Okay. So under the total alternatives approach, you're looking at the 15 million and the 16 million be the total future costs of making / buying video system DVD players. Then next one down, you would deduct any excess of future revenues over future costs from Digitech. So you basically are saying there, okay, Digitech under alternative 2 is going to make 2,500,000. So let's subtract that from the total costs of making, or in this case of buying, the video systems. So your overall relevant costs under the total alternatives approach gives you 13.5 versus 15 for option 1. Well, looking back down on the next row section there, panel B, you're basically doing the same analysis. The difference is that instead of showing the 2,500,000 under option 2, which is the option that allows you to get that extra money, you're showing it under option 1 because you're showing that as an opportunity cost. So basically, because you decided not to do option 2, you're losing out on the opportunity to make Digitech. Okay, um, and then if you read this situation from the book, it goes into a little bit of a description on um, what this actually is. And basically, um, if you make the video system DVD players, you're not able to also make Digitech. But if you buy them, you're able to make Digitech, which gives you this extra revenue. So um, either way, when you're comparing option 1 to option 2, option 1 has 1,500,000 more in costs than option 2. Okay, the only difference is, do you look at the 2,500,000 under the current system as an opportunity cost, or do you look at the 2,500,000 under the optional other system as a source of additional revenue on that side? That's kind of offsetting the costs over on that side. So again, like I said, it's basically just a matter of semantics between those two. And the basic analysis that you're doing is saying, again, looking at relevant costs, relevant revenues, and making it a determination as to which one puts you better off in the future, regardless of which way you go on the semantics issue. So carrying costs of inventory is just an example of opportunity costs, because any inventory that you're carrying on hand, that you're just sitting on, basically is money that could have been spent, or resources that could have been devoted to some other purpose if you had been, like a just-in-time manufacturer, where you are, not sitting on any inventory, you're just making it as the orders come in. Then obviously you wouldn't have to spend the money to have inventory sitting in your warehouse. That money could be invested or put into some other project, and you could have some other opportunity there. So this next learning objective is basically comes down to product mix decisions. So this is basically when you only have a certain amount of capacity, and the demand is such that you're going to end up using all of your capacity one way or the other. Now this is a situation where you have maybe one, two, or maybe two or more, not one, but two or more products that you are manufacturing. You don't have any excess capacity, and so now you have to make a decision: what percent, or what product mix, or how much should I make of each product in order to maximize my contribution margin, and eventually my income for whatever organization I'm working with. So here's an example of that. Basically, we have the option of producing these snowmobile engines, or we have the option of producing these boat engines. So we have a list of some costs here: selling price, contribution margin as a per unit amount, and also as a percentage. And then we combine the contribution margin per unit with the information we have on machine hours required to produce one unit, and we are able to set a contribution margin per machine hour. Okay, so when we convert this to the per machine hour contribution margin, now we can make a head-to-head decision, because we can see, okay, for each machine hour we get $120 of contribution margin out of the snowmobile engine versus $75 out of the boat engine. So what does that tell you? Well, that tells you that I'm going to want to put as many uh, machine hours into the snowmobile engine as I can, because even if I devote all my machine hours to the snowmobile engine, as long as there's enough demand for that, that's going to be the way that I'm going to maximize my revenue. Okay, so bottlenecks are another key issue that we need to look at here. And now we're looking at more of a managerial standpoint, and not, I don't want to say that we're not looking at the financial aspects of this, because we are, but we're looking at the financial aspects of bottlenecks, in that we are obviously, we're looking at the bottom line, the goal. The goal is to produce as much revenue as we can, produce as much income as we can. So theory of constraints basically describes methods to maximize operating income when faced with some bottleneck and some non-bottleneck operations. So, a bottleneck is where, if you're looking at a bottle and you go to pour the bottle out, um, it takes a few seconds for all, like if you have a soda bottle, you go to pour it out, it doesn't just all dump out immediately. It takes a little while, because basically you have the wider part of the bottle at the bottom, and then it closes into a smaller kind of funnel, which is called the bottleneck, and that slows down the process of everything behind it. So the rest of that liquid is ready to come out, but it's being slowed down by this slow piece of the process. Okay, so here are three definitional measures to maximize operating income as defined by the theory of constraints. So throughput margin equals revenues, and this is just, throughput margin is a vocabulary term that you will see when looking at bottlenecks, and especially through the lens of the theory of constraints. But that throughput margin just equals revenues minus direct material cost of goods sold. Investments, which is the second measure, is the sum of materials costs in direct materials, work in process, and finished goods, research and development costs, and costs of equipment and buildings. And then the third measure that we look at is operating costs. And that's basically defined as all costs of operations incurred to earn throughput contribution. So that's basically all the operating costs except for direct materials. Okay, so here's how we manage bottlenecks in a situation where we have some components of whatever process we're looking at that are bottlenecks, and some that are not. Okay, again, this is even though it's a four-step process, we don't want to necessarily go through a checklist. We just want to know that these are not necessarily in descending order. Just four concepts that can be used to work through a bottleneck situation. So first of all, the first step is recognizing essentially the importance of solving the bottleneck operation, because you have to recognize that you are basically putting a speed governor on your whole process by having this bottleneck that slows you down. Number two, identify the bottleneck operation by identifying operations with large quantities of inventory waiting to be worked on. So, it's not hard to find what area this is. If you're in a factory, where does everything pile up before it goes through which process? Just walking through the factory, you should easily be able to identify these areas, because you'll have, some factory workers that are just standing around waiting for the bottleneck to clear, and wherever the bottleneck is, you got people working furiously, inventory piling up, and just waiting to go through. So pretty easy to determine where that is. Number three, keep the bottleneck operation busy and subordinate all non-bottleneck operations to the bottleneck operation. So what that means is, obviously, you're going to do everything in your power to manage your resources in a way that allows the bottleneck operation to continue to operate and to operate more effectively and more efficiently than the other operations, even if that means devoting resources that you normally have all allocated to the non-bottleneck operations. So for instance, if you've got guys standing around in the factory that, for their part of the operation, they got to wait on the bottleneck, well, it might be more efficient to have, once inventory starts to pile up in one area, if the bottleneck's due to a lack of labor in that area, then you could devote some laborers that are standing around, push them over to the bottleneck operation, and get that running smoothly. Another non-labor way of looking at this in devoting resources is, you may have certain tools, like a number of forklifts that you need to do XYZ job. Well, you may have one devoted to each section of your factory, but your bottleneck is because you don't have the forklift is going too slow or whatever. Well, maybe you should devote and have some of those other non-bottleneck areas wait for the forklift in order to devote to the bottleneck area, so that you are speeding that operation up. Now, obviously, this is a managerial call, because as you devote resources more and more from the non-bottleneck operations to the bottleneck operation, eventually you could create bottlenecks in the other parts of the operation. So this is something, it's a dynamic process that you keep your eye on. These are pretty self-explanatory. When we talk about throughput contribution, we're basically talking about increasing the amount of product that flows through and is actually sold. Just processing parts that go to products that end up sitting in finished goods for a long time before they get sold don't actually increase throughput contribution. So we want to make sure that we are devoting the resources with the eye on the prize, when the prize being that we want to generate more revenue. We generate more revenue by having more sales, not just producing products in an efficient manner, but producing the right products that have the demand, the most demand, and are able to be immediately sold. And all these still go to actions you can take to relieve bottlenecks, but they basically all kind of center around the same idea of manipulating and managing your resources in a way that you're devoting the most resources to the bottlenecks, and keep devoting more and more resources to the bottlenecks until you get to a point where either there is no bottleneck, or if you go too far, then you're creating bottlenecks in other places. But right up until that point, each additional resource that you devote to the bottleneck that doesn't end up creating a bottleneck somewhere else in the process is going to end up making the whole process more efficient. Okay, this is moving on to a slightly different concept, where we're looking at making the decision to add or drop a product line, a business segment, a branch office, or even customers, whether you're going to end up firing a customer because they just aren't worth the stress or the cost or whatever the case may be. Again, we're going to be looking at relevant revenue, relevant costs, and that analysis can help in the decision-making process. So here is a look at some customer profitability for Allied West. You can see the relevant effect that each one has on operating income. And here is again a look at just some options that you have here. What is the relevant loss in revenues or relevant savings from dropping the whisk account, what's the relevant cost from adding the Loral account, and bottom line totals there, just, if it's a negative number, basically bad, positive number, good. That means that that's contributing that amount of revenue, or if it's a negative number, it's causing that amount of loss on the operating income. Here is the similar analysis, just the different types of cost change, but this is okay. Do we want to close a branch office? Do we want to open a new branch office? So if we closed Allied West, the relevant revenues and costs come down to to net out to the effect on operating income, which would be a $42,000 loss. Obviously, that would be negative. We don't want that. Versus number 2 there, opening another branch, we look down at the overall effect that it has on income, and that's a gain. I don't want to say a huge gain, but a sizable gain at least. So, maybe that's not enough. $17,000. Maybe that's not enough to make it a no-brainer decision. But it's definitely it's not negative. So, this is where the other qualitative and non-financial quantitative factors would come into play in determining whether this would be a decision that we want to make. Okay, so we're going to talk a little bit about book value of equipment and why that's irrelevant to making equipment replacement decisions. I think the main reason that this becomes an issue is because you have a lot of you devote as a manager a lot of time and money into accounting for equipment, and in doing so you're recording the costs, you're recording the accumulated depreciation on the asset, and you're recording the book value of the existing equipment. So it's very tempting to look at that and look at any book gain or loss that you would see on the transaction and make that part of your decision-making process. The problem with that is that in doing so, you're basically looking at a lot of sunk costs and using those to make decisions about the future. Remember, when we're making decisions about the future, the relevant revenues and the relevant costs are only the future revenues and future costs associated with that decision. So something that I already purchased in the past is not what I should be worried about. What I should be worried about is how much does it cost to purchase a new piece of equipment, okay? And how much would it cost to continue to maintain the current piece of equipment into the future? And if I did purchase a new piece of equipment, I would look at how much salvage value or what the trade-in value of my current equipment is, because that would go to reduce my future costs. But the fact that I paid XYZ dollars, or that the book value based on the accumulated depreciation is, $20,000, or that if I trade it in, my book value is $20,000, I can only get $5,000 out of it for trading it in, so I'm generating a loss. All of that is just, it's book gains and book losses. It's a financial accounting phenomenon only, which basically means, yes, it affects the books, but no, it shouldn't really go into the factor. It should not be a factor that goes into your analysis for making equipment replacing decisions. So let's look at this here. We're looking at the data for existing and replacement machines. So we see the original cost of the old machine, which is going to be irrelevant for making the decision. And then we see this other information here. So let's skip over to an actual look at the relevant numbers associated with this. So revenue doesn't change whether we and we're looking at this from you see at the top there it says 2 years together, so this is grouping 2 years of costs together. And the reason that they're doing that, the reason that we're doing that is because um, obviously it costs a lot of money to purchase an item, and since we're not we're not looking at the accounting of depreciating an asset or recognizing depreciation expense. So in our decision-making process, we're looking at the full cost of the item. Um, so because of that, that's going to, if we only look at 1 year's worth of information, then that full cost of the item weighs very heavily against investing in new equipment. But if you add, in this case, 2 years together, and the more years you clump together, the more relevant this is going to be, or the more pronounced effect this is going to have on the analysis. But so basically, revenues stay the same. Cash operating costs significantly lower to operate the new equipment. And this is considering all of the maintenance costs and stuff for the old equipment. We are showing a lump sum or periodic write-off for depreciation. That is not something that we care about as the relevant information there, because basically that is going to net itself out with the lump sum write-off from replacement section there. So you see that that carries over to the relevant area 0. Current disposal value of the old machine of $40,000 basically goes to reduce the costs of it goes to reducing the cost of the replacement, because that whatever it costs to replace the new machine, you're going to take some money out of that for basically the trade-in value that you got from the old machine. And we see that $600,000 is the new machine cost, and it says written off periodically as depreciation. That doesn't go into our analysis. So you see the difference there is going to be $120,000, and that shows you that you would have $320,000 from as operating income from the replacement equipment versus $200,000 as operating income under the current equipment. If we just look at the relevant costs, the difference is $120,000, with the lower relevant costs being for the new equipment. Again, you're just having basically operating costs, which is going to be maintenance, upkeep, that kind of thing, and just the cost to keep it going. That's the only thing you see for the equipment that we currently have, because we already bought it. For the equipment that we're going to buy in the future, we have that cost, although it's substantially lower. And then we also have the new cost of the machine minus the trade-in value of the old machine. So this slide basically goes to a phenomenon that we haven't spent a ton of time on in class, but that it's an important one for managerial decision making, and that is the concept of agency. And that is that basically, even though some quantitative analyses don't really lend themselves to if the quantitative analysis is very decided and very heavily favoring one decision over the other, it would be a hard situation or difficult for managers to choose the other option. However, when the choices are not so clear-cut, you're going to run into a problem where managers aren't always necessarily looking out for the firm's best interests. And that becomes an agency problem, which basically suggests that different actors within any organization are going to be looking out for their best interests. So from a managerial standpoint, where that becomes important is that you as the upper level manager are going to want to set up the system of rewards and the compensation system in such a way that you can align the goals of the managers as closely as possible with the goals of the organization. That's kind of one of the important arts in business management is being able to design a system of rewards and compensation that allows you, because that's basically your best tool to work with, but that allows you to align the goals of management with the goals of the company. It's very nice to say, oh, I expect everyone's going to be very full of integrity and going to do what's in the best interest of the company, regardless of how that affects them. But in actuality, we have to assume that that is not the case, and that most of the time, if they can, people will tend to make decisions that are in their own best interests. So that's just something to keep in the back of your head when you're making any type of managerial decision, and when you're analyzing the decisions made by lower level managers underneath or within your responsibility. You have to keep in mind that anytime the non-quantitative financial part of the analysis is left in the hands of managers, they're going to oftentimes consciously or unconsciously make decisions that are in their own best interests. So let's look at a couple of questions here. First one, the Fluffy Company manufactures slippers and sells them at $13 per pair. Variable manufacturing cost is $4.75 a pair. Fixed cost is $3 per pair. Fluffy has enough idle capacity available to accept a one-time only special order of 25,000 pairs of slippers at $7.75 a pair. Fluffy will not incur any marketing costs as a result of the special order. What would the effect on operating income be if Fluffy could accept the special order without affecting normal sales? So we're going to assume that normal sales happen as they normally do, and that this special order essentially has no adverse effect on anything. So all we have to do here is look at the variable costs, variable manufacturing costs of $4.75 a pair. Excuse me. Look at the amount that they're willing to pay us, $7.75 a pair, and then if we subtract the $4.75 from the $7.75, that gives us the contribution margin per unit for this order, which would be $3 per pair. Multiply that times 25,000 units, and that equals an increase in operating income of 75,000. So you'll notice that there is that fixed manufacturing cost in there, but we're assuming, since it's a fixed cost, that this special order shouldn't increase the overall fixed cost for manufacturing. Okay, question 2. Lawn Wolf, a manufacturer of lawnmowers, predicts that it will purchase 240,000 spark plugs next year. Lawn Wolf estimates that 20,000 spark plugs will be required each month. The supplier quotes a price of $11 per spark plug. The supplier also offers a special discount option. If Lawn Wolf purchases all 240,000 spark plugs at the start of the year, the supplier gives a discount of 4% off the $11 price. Lawn Wolf can invest its cash at 10% per year. Lawn Wolf spends $220 to place each purchase order. What is the opportunity cost for Lawn Wolf of interest foregone from purchasing all 240,000 units at the start of the year instead of in 12 monthly purchases of 20,000 per order? would managers record the opportunity cost in the accounting system and why? So first order of business is going to be determining what the unit cost or the cost per unit is for orders of 20,000 versus the cost per unit for orders of 240,000. And all we have to do is, we're given the $11 per unit for the 20,000 order, so that's the unit cost there. Multiply that times 96%, and that gives us the unit costs under the discounted method. So if we skip over here to the answer, we've got those two unit costs. We're going to multiply. First we're going to look at a ratio here, which was covered in your book if you read that part, which is called I don't necessarily expect the non-accounting people to be all that familiar with this ratio, but it is one that can be useful in decision making. It's called the average investment and inventory ratio, and for this ratio we're basically multiplying the total amounts we're going to be purchasing under each of those order scenarios for one order and dividing that by 2, and that gives us our average investment in inventory under each of those scenarios. You take the difference of those two, that gives you $1,157,200. That's the amount of money that we would use to say, okay, this is the amount of money we could have invested elsewhere. So that amount of money you would multiply times the 10% rate that we're expected to earn, and that would give you, just take away, move the decimal point over 1, and that would give you $115,720 of opportunity costs that you would have for choosing option A of buying all up front versus 20,000 units at the start of each month. The second part of the question was, does that opportunity cost get recorded on the books? No, it doesn't, because we are not, an opportunity cost shows us basically what we're missing out on by selecting this option. Well, obviously on the books we want to only record actions that we've taken, not actions or the effects of actions that we have not taken. So no, opportunity costs never show up on the books. So that's kind of a trick question there. They're only used for the decision-making process. Question 3, GST Corporation runs 2 convenience stores, one in Minneapolis and one in St. Paul. Operating income for each store in 2013 is as follows. We've got some information there for the Minneapolis store, for the St. Paul store. You can go down and look at the revenues, cost of goods sold, various other costs, and they net down there to operating income or loss. The equipment has a 0 disposal value. In a senior management meeting, Sven Larson, a management accountant at GST Corp., comments, GST can increase profitability by closing down the St. Paul store or by adding another store like it. Question. By closing down the St. Paul store, GST can reduce overall corporate overhead costs by $88,000. Calculate GST's operating income if it closes the St. Paul store. Is Sven Larson's statement about the effect of closing the store correct? Explain. Okay, so it's giving us what the overhead costs would be by closing down the store. If you look at the chart there, you see an allocated corporate overhead cost to the St. Paul store of $80,000. However, since our analysis here, we have a specific amount of overhead costs that we've calculated that will be saved by closing down the store. Okay, so this could come in the source of, maybe that store has requires additional administration, whatever the case may be. There's a difference between what we've allocated to that store and the actual cost that we'll save, or that we're calculating we'll save by closing it down. Okay, so basically we want to use $88,000 as the amount that we are going to be saving there versus the $80,000 that you see there. Okay, so would that end up increasing profitability? So if you net out all of these, well, you would have to take away the revenue that you would lose, and then add back in all the costs that you save. So you'd basically start with negative 1,720,000 because that's the revenue you lost. Add back in cost of goods sold, 1,320,000. Add back in lease rent, 150,000. Add back in labor costs, 84,000. Depreciation of equipment is just an accounting a fiction basically. So that actually is not, it's just a book expense. So it's not something we're actually going to be saving by closing down the store. So we can't add that back in. So just skip the 44,000. Add back in the 92,000 of utilities, and instead of that $80,000, you're going to add back in 88,000 because that's the actual amount we've calculated that we'll save in corporate overhead costs. When you total those out, you come up with $14,000 of savings by closing the St. Paul store. Okay, so that's the end of the questions that we're going to look at. Basically, there's not too many questions in this chapter that that cover material outside of what we're looking at. It's from a conceptual standpoint, we've talked about a lot of different concepts, but from an actual practical standpoint, as far as look at specific problem XYZ and do process 1, 2, 3. It basically boils down to looking at relevant costs, making sure whatever you're looking at is relevant, and using some managerial discretion and making decisions that way.